Everybody, today is Wednesday, the 8th day of June 2011, and let's take a look at this market here. For those of you who might be newer followers, my name is Brian Shannon. I've got my site at alphatrends.net, which is part of StockTwits, and maybe you're going to view this on YouTube later. If you're not on Twitter, if you're not on StockTwits, do join up. It's really a great resource for traders and investors. I've met a ton of great people in person through Twitter and StockTwits, and I would encourage you to do the same. Anyways, let's take a look at these markets here. The S&P 500 continued lower for, I guess, now the sixth straight day. It looked like we were trying to bounce around that 150-day moving average the last couple days. And what I said, what I've been saying is that over the last couple sessions is that was our initial target, or a target for this market on the downside at the 150-day moving average. But these moving averages are like a more magnetic force field. They're not a line in the sand where you buy or sell. That, technical analysis should be viewed as a tool, not as a system. So we want to use that tool to say where is that magnetic field likely to be stronger? Where do we get closer to those poles? And those poles tend to be a lot of times at moving averages or right near them. They're not exact, precise buy or sell levels. And I was pointing to saying that I've been looking for the potential of a bounce in here. Fortunately, through not taking large positions and being too early on these things, you can still make it through. Obviously, the hindsight's perfect, and the obvious thing to do in hindsight would have been to get short and stay short. We do still have a pattern here that's of lower highs and lower lows below the declining 5-day moving average, and I've been looking incorrectly for that bounce based on the magnitude of the decline, us taking out these April lows and coming down to that 150-day moving average. But again, looking for a bounce and getting your ass handed to you are a different story, and hopefully no one's having that happen to them in this market. I was pointing, though, the point I was trying to make was that these moving averages, we don't want to buy just because it's at that moving average, and I was pointing out how the retail holders, I pointed this out in a couple videos Friday and then on Monday, that the retail holders broke through this prior level of resistance, and that resistance looked like it was going to hold a support near the 50-day moving average. Well, the 50-day moving average failed, the 100-day moving average failed, and then the 150-day moving average failed. So when that 150-day moving average failed last week, I was pointing it out, saying, be aware that, this is a potential area for support to be found. We only know support in hindsight. We can only take a look at the chart afterwards and say, hey, there was resistance at 137.5. Hey, there was resistance at whatever level. When we get up to, like we did last week, this becomes a potential level of resistance. And then we know after the fact, when it moved away from that level, that it was in fact resistance. Now we're in an area that, potentially we're going to find some resistance, but the proof still isn't there yet. We're not seeing that this market is starting to you could say the deterioration has slowed down a little bit, but slowing the pace of a decline is not a bullish event. It's still, we can still draw all kinds of downtrend lines. We can look at different moving averages and prior levels, but that's really not going to help us pinpoint a buy place. What we need is we get a correction through price, then maybe a little bit of a correction through time, then the bounce. Sometimes we'll get a quick strong sell-off. Maybe we gap down tomorrow morning and then reverse higher. That's kind of been that's what I thought would happen actually today. We didn't have that happen, of course. Let's take a look at just today's action. We had the market actually, initially a little bit stronger here. after let's just frame that around 2 days. We had a gap down, a little bit of strength, and then that quickly failed. It stayed below or broke back below the volume weighted average price, and we've just been kind of really choppy. Today was a very choppy day. You could look at it and say it was an easy day to sell short, but I don't think that's the case either, because if you look at the ranges and how much how much range we traveled, it wasn't much range at all, and for a lot of the day we were locked within just some very choppy trading activity. So what's next for this market? Well, we're getting really deeply sold off. There was something that I had retweeted today talking about the down 5 days in a row, that 100% of the 11 out of 11 times that it bounced, and I had actually said jokingly to a friend this morning, said it sounds like it's overdue to for that trend to stop or reverse. I don't remember specifically what that statistic was. I'm looking for it right now here. Anyways, that was earlier today. S&P has dropped. When the spider has dropped 5 straight days into a Tuesday 11 times, all 11 rallied on a Wednesday. Well, today's the 1 out of 12 where it hasn't. No indicator is perfect. No statistic is going to make you money all the time. You can look at that and say, hey, the odds were there, and that's a nice little tidbit of knowledge. And we are down a lot, and we are near this rising 150-day moving average. So all that put together, you come into the day, and my mindset was, I think we're probably going to bounce here today, but and I tried it a few times and got paper cuts like I think most people did. I think it was about in this area right in here. I said it looked like the lows were probably in for the day, and then I recanted that over here as it broke back below VWAP, saying, it's just too murky. There's really no sign of a reversal coming. So just because it seems down too much, there is no such thing as down too much. Not if you have more willing sellers, supply coming into this market, and it's not always willing supply either. I mean, there are people who get loaded up on margin on the upside too. We hear about a short squeeze all the time. Well, the longs are getting squeezed out of this market too with this persistent selling. So I think I said on Monday, the last couple of days, that really, if you're going to try to trade for a bounce, that's fine. There's things to look for technically, but then you have to be very careful about your position sizing and being able to move to the sidelines quickly. So you have to have a flexible mind in trading, obviously, and no one's gonna make money at every turn. And finding those turns is really a lot of times comes after you've tried it 10 times in a row. You get these little paper cut losses, and then it finally goes without you, and that seems to be my experience with trying to pick tops and bottoms, which is why it's not something that I really enjoy doing. And so far, that's my experience in here right now, is that that I've experienced paper cut losses that annoy the hell out of you. But if you don't watch out for those paper cuts, you can still, of course, die the death of 1,000 paper cuts, as they say. So the S&P 500, let's take a look at where it has the potential still to go. We did come down through this level here from March 23rd. That was something I was looking at as a potential level of importance. We've got this level from back in January that acted as a little bit of resistance. It's tough to say where, what we really need to do more than anything is just kind of focus more on this trend. We have the pattern of lower highs and lower lows. It does seem like we should get a big bounce in here somewhere. And maybe we get a bounce up towards that 130 level, or the where the 5-day moving average is, and we saw a little bit of resistance so far this week. But the selling remains obviously the sellers are in control of the S&P. They're in control of the Nasdaq here. We have that April low down at what was this level here? This was 55.32, and today we did undercut that level slightly. Today's low was 55.23. So a lot of people were looking at that as the important level. I was looking at it definitely as an important level. That maybe that's where the sellers let off a little bit here. And again, the magnitude of the decline, in this market that we've enjoyed here, basically since September. This is, we've had one other meaningful sell-off, and now we're getting down to levels that are, we're coming close to that 200-day moving average, which is now at about $54.30, and that's something that's realistic now. It's not something that seemed realistic maybe a couple weeks ago when we were battling away at that 59 and change level, but now it's a realistic level that maybe we're just going to flush it down to the 200-day moving average. And again, I wouldn't buy at the 200-day moving average. I wouldn't suggest that you buy at the 200-day moving average, but it's a level to look at. It's an area of interest where we say that should be a strong magnetic force, but then maybe we get repelled from that magnetic force. It's just a tool to say, here's where there's the potential for buyers to show up. So what we do is we take a look at it and we say, okay, there's this potential level at the 150-day moving average at 56.30. So then we take a look at the shorter term time frame at 56.30, and what do we see? Well, we saw a little bit of support forming in there at 56.30, but did we break the pattern of lower highs and lower lows? No, we did not. We continue to establish and continue this pattern of lower highs and lower lows. So those, again, these levels, we want to look at these moving averages. We want to look at these prior levels of significance, $55.32, and then we want to look at it and say, okay, at $55.32, is something significant happening in that level at that precise number? And it's not going to be a precise number, but the answer is no. And we rallied twice this afternoon up to the volume weighted average price in the Qs, and we actually got above it. It looked like maybe they were going to try to push it higher right in here, but that rally attempt failed as well in the SPY. So we have to look at technical levels again as not lines in the sand. We don't know where support will be. You can't say, oh, the market has support here. The market may have had support at a level in the past, and now it becomes a potential area where the sellers will slow down their activity and where the buyers start to come in and feel a little bit more comfortable that the prices are at a reasonable level for them to nibble, and that supply-demand equation starts to even out a little bit. We get a little bit more demand to offset the supply, prices stabilize, and then the sellers, the shorts figure, hey, I'm going to start to cover my profits. That adds some demand. Who's left to sell? And then we can get these monster rallies, and that's what's really appealing. And that's the crack, that's the high that bottom searchers feed on. That you can get these super snapback rallies that you can make a lot of money real quick, and who doesn't like to make money quick? But it's dangerous. And what happened, I think, in here is that people got a little bit too accustomed to looking for that snapback rally, and now they're just kind of getting ground out of this market slowly. So it feels like there's a lot of frustration out there. I feel it myself, and generally when that frustration level is highest, and of course, how do you quantify that? That's something that is elusive. How do you quantify when the emotional level reaches its highest area? You don't, but it seems to be getting very high here, and that's when it oftentimes becomes ready for that type of bounce. If you haven't been looking for shorts, if you just got into cash maybe a day ago, 2 days ago, and now you have now you're finding yourself scrambling to look for short side exposure, ask yourself, are you getting in early here on the short sale, or after this, the magnitude of the decline that we've seen. Are we getting a little bit overdone on the downside, and and possibly due for one of these snapback rallies? And if we snap back, well, you enjoy that ride. But until then, where does the Russell 2000 have the potential to go? Maybe down to this 78 level, and again, support is more of an area, not a precise level. 77 to 78 has been the important level this year so far. That's where we've seen this little band of support, and obviously we're coming down quickly. Again, here we've paused at the 50-day moving average and saw a bounce. We paused at the 100-day moving average. Well, there was no pause and bounce here at the 150-day moving average. It's not a method that's going to work. It's what we want to do again is take a look at the shorter term time frames and say, are we starting to see, like yesterday, well, we're seeing some resistance. Now, if we came down in here today and did something like this, that would have been a better buy, I think, and then possibly a trade up towards that 5-day moving average. Obviously, the market gapped lower and stayed weak in the Russell 2000. Yesterday's, the lows from this week prior to today acted as resistance. So we're seeing a stair step lower, just a gradual stair step, steady liquidation of stocks in here, and it's not showing signs of reversing. So that's the key takeaway here is we seem oversold, we're down a lot, but we simply are not bouncing, and until we get that evidence of a bounce, it's going to be very frustrating to anyone who's trying to pick the turning point. So again, if you're trying to pick that turning point, look at levels and say, well, maybe tomorrow it gets going up here a little bit, but we've still got these bigger headwinds from the larger term time frame that say, wait a minute, we're still below declining 5-day moving averages, guilty till proven innocent. Just because it's down a lot and it seems like it should bounce doesn't mean it will. The semiconductors have really gotten the shit kicked out of them after coming up to these highs. And we had seen that this was really one of the stronger groups, the 37 level. Obviously we came down to that 50-day moving average. A lot of people, I think, were buying in there because we had prior support in that area. We did get a little bit of a bounce, and then what happened? Well, we came down through the 100-day moving average, and that seemed pretty excessive, but it got a bounce after intraday touching that level. We got down to the 150-day moving average on Monday, and no real bounce in there. So what's the next level? Well, look where we are. We're down at these levels now, and this market appears to be no support. Of course, the market will turn and let us know in hindsight what the support level was. It's I took some stabs at the semiconductors in here today and got basically what I deserve for trying to pick a bottom, which was some losses in here. Tomorrow, these will be some important levels that maybe we can get some bounces above there, but after paper cut losses, do you still have the stamina to come back and fight again the next day? And the only way that you can answer yes to that, in my opinion, is if you've been doing it, that is trying to pick the turns in a low risk way, which means again smaller share size and having your finger on the trigger quick and saying, what, it's just not happening here. So I've got to put my emotions of, hey, it's down too much, to the side, and instead say, this market is telling me that there's sellers in here. If we took a measured move, which I hadn't done yet, but if we take a measured move basically from this high to this, so we would call this point A, B, C, and that would give us an objective of D. So let's just take the height of that. And the way we'll do that in the semiconductors here is we'll grab this and we're just going to take it from that high to there. And excuse me, so from point C, and that we've exceeded the measured move target as well. We're down into this area that had been prior support, but we're through, we're down through and to and through these little levels. They seem like they're due for a bounce, but you know what? The price isn't confirming it, so seems like is not something that's going to pay you. The only thing that pays is price, and that's why you have to manage risk if you're looking for this turning point. Anyways, again, the retailers, another group that have just been really annihilated here. This was a breakout to all-time highs just a couple of months ago, and from that failed move higher came a fast move lower. And a couple weeks ago, to think that we'd be, thinking it was reasonable to test the 200-day moving average seemed highly unlikely, but here we are, and this is again why trends change, and we have to be up on top of that price action. And these are the types of trend changes that occur quickly and violently that make me a trader instead of being somebody who wants to form an opinion and say no, I still think the retailers are good or whatever. Anyways, let's take a look also at the IYR, because someone was asking me about the triple. I think it's DRV, and these levered ETFs, they can be a very quick death to you if you get involved in them too heavily. But if you're looking at the IYR, it's really been resilient. This prior resistance has held as support so far. We're still actually holding the 50-day moving average in the real estate investment trust, and it's just amazing the run that this group has had when the loudest second shoe noise was coming over in here 2 years ago. But here we are today with this massive uptrend still really intact. We've got this prior resistance holding a support. I wouldn't be surprised to to see some catch up maybe to the downside in here, but overall it looks generally pretty solid still. But if it breaks this 60 level, then I think you'd maybe see a move down in towards these 59ish area. But you just look at the overall market, it's hard to trust anything that is holding up in here. And this is one of those times, those periods in the market where the strong defense really really shows its value here, and why you spend the off season building up your defense as well. And that's just as strong a more important skill, I think, than even just knowing when to lean into it with big position size. Anyway, that's going to do it for today. I'm not going to look at stocks because pretty much they're all busted. I think that for the most part it's kind of too late to sell short, and the market hasn't proven that it's the right time to buy yet either. So I think little activity is still the proper course of action here for at least a couple days. And because I say that, the market probably rips higher tomorrow. But you have to tweak your analysis with new information that the market gives us. It's dynamic, and that's what developing a trading skill set is all about. Not just being able to analyze the market properly, but having the tools or the skills and the discipline to implement those strategies and make sure that strong defense is intact. So thanks for tuning in. That will do it for today.